That's not the way it's done in, the US, for instance, is not done like that.
This will be for, you're thinking of some of the fintech challenger banks that are small?
Yeah. And Sam Woods has called this the strong and simple approach to simplify regulation. We want to do that now. I have to say that in order to do that, we do have to implement the new Basel rules, because we need you to do something in Parliament to unlock this, to unlock the ability to.
Well, just for the ease of anyone who might not be a banker or a Bank of England follower, who may be tuning into what you're saying, what would that mean for the consumer? Then what difference do you think that will make?
Well, I hope it would improve the competition in the banking industry, so it would improve the choices that consumers have. Actually, we've had quite strong entry into the banking markets in the last decade. The number of new banks created has been higher than ever before. I think now the question is not so much that; it's actually ensuring that these institutions can grow into real sort of challengers on for
the big six
for the public. So that's important that we do that. So we do need an agreement on Basel going forwards. We have delayed that because of the uncertainty from the US angle, because there's a competition issue. There's an issue there as well.
We'll come into some of that later.
But that's one example. I think we can do a lot on data reporting to simplify it. We'd like to make quite a substantial investment there with the industry, both to simplify it and in terms of the amount we collect, but also to make it more efficient. And I think we can do a lot on that front. So a number of things we can do there, and we will do. On the insurance front, there has been quite a lengthy process. Mr. Glenn will be very familiar with this, around the so-called Solvency II regime that came across from Europe. I think we've now broadly settled that, but it's obviously got to be implemented and put into effect. And I think we've had a lot of discussions with the industry. There is the potential for very substantial investment to come out of this. It's really out of life insurance. It's in that world. And again, that will support growth. Now, the FPC's job is essentially the overarching view. Are all these things consistent with financial stability? And I think they are, is the answer. We can do these things consistently.
We'll get into detail on some issues, but before we go into the main session, Rachel Blake.
Thank you very much, Chair. You've set out that there are opportunities after Brexit and with international standards. And you also said that the economic growth objective isn't new. And so I'm interested in, obviously, Brexit is a change and international circumstances and standards is a change. But I'd really like to understand why those changes that you're talking about around data reporting and then also data reporting are new, and why you're able to change them now rather than previously.
Lots of the data reporting actually does follow from having more scope post-Brexit to choose what we do. The EU arrangement, and I should say, I always preface this by saying I take no position on Brexit per se. So this is not me suddenly giving you a message on Brexit. I'm not going to do that. But there is an opportunity, and the opportunity is that it gives us more choice. The EU is quite prescriptive when you're in the EU over data reporting, for instance. So we do have more choice. And there is frankly, there is quite a lot of that reporting which, when you talk to the people who supervise banks, they say, well, actually, we don't use it all. So there's an opportunity to be sort of more nimble, frankly, I think, on that front.
So are you saying then that opportunity with changes to EU regulations is the only thing that could possibly have changed from previous governments' objectives around economic growth? What I'm trying to get at is you identified some categories of opportunities, and I'm trying to get at what detailed opportunities there are that aren't linked to Brexit.
Well, I think there's a whole set of other opportunities that come along as a consequence of technology changing. So as a consequence of the fintech, financial technology changes there, which can make it more efficient. We are also, I think, like all organisations, looking at how we can use artificial intelligence in terms of what we actually do. So that's important as well. We've also made we've made several other changes. So. You may be aware, we've changed some of the way in which we regulate remuneration. Now, you may say, well, that's all very nice. Does that really contribute to growth and competitiveness? Well, the fact is we thought we were never strong supporters of these regulations. So in terms of reducing the burden of regulation, we think those are sensible things to do as well.
Okay. And just to come back on your observation around additional competition in the banking sector, are there other benefits to consumers that you can identify?
Well, I think there are benefits in terms of the cost of financial services. Now, it's not easy to map those one for one, don't get me wrong, but I think we have to admit regulation does come with a cost. There's no question about that. I mean, the industry will tell you that quite forcefully, I'm sure. So I think, again, we have an obligation to ensure that the efficiency and cost of regulation is an objective, because it does get passed through to consumers ultimately. So yes, in that sense.
Okay, I think
thank you very much for now, Ms. Blake. Dr. Jeevan-Sander MP, over to you.
Thank you very much, Chair. Thank you all for coming in. Governor, I wanted to ask you about some of your actions around the APF, QT, and particularly its impact on financial stability. Could you outline how you at the Bank of England are approaching unwinding and selling off the assets you created underneath quantitative easing and the implied effect on interest rates? Yeah,
so I made a speech at the London School of Economics the day before the election was declared, actually last year, coincidentally, by the way. Just to be clear, on this, setting out our approach towards this, and really setting out that there are, in my view, two phases to this. And the reason for that is that if you look at our balance sheet, on one side of the balance sheet is a set of what we call reserves, which is the balances that banks hold with us. And that is the highest, in a sense, quality stock of liquidity they can hold, because it's effectively cash. And on the other side is assets. And those assets are essentially, at the moment, the stock of quantitative easing. So it's gilts. Now, the question we face then is, if you look at history, if you go back to before the financial crisis, we had a very small stock of reserves. It was too small. You can operate monetary policy in normal times with a very small stock of reserves. Unfortunately, for financial stability purposes, you need a larger stock of reserves, because that is, as I say, is the liquidity buffers that the banks maintain, so that every day they've got cash available. It also runs a payment system as well. Now, obviously, during the quantitative easing programme, we increased that stock of reserves, and we increased it very deliberately above the level that you would need in normal times. And that was deliberate because of the monetary policy objective. The objective today is the first phase of the objective, therefore, is to bring that stock of reserves down to what is the equilibrium level. Now, we don't know what that is, because we've gone from a pre-financial crisis, it was too low, to a deliberate excess during quantitative easing. And so we've got to find that middle ground. And the distance is very large. I mean, we had, getting on for £1 trillion of reserves at the peak. Pre-financial crisis, we were actually operating sometimes with only about £30 billion of reserves. Now, we've done quite a lot of work to say, well, where is that equilibrium? We'll know it when we, by the way, we'll know it when we see it, sort of thing. We talk to the banks a lot about it. They give us numbers which are in the range of sort of £400 to £500 billion, but we don't precisely know, and it can change over time. So, but the first phase is therefore to get down to that level, and we're well on the way. I mean, we think, based on what the conversations we have with the banks, that we may get there later this year. We'll see.
And so now, just the impacts of this quantitative tightening on interest rates, what do you see that as being? So Dave Ramsden in June 23 said there was an unexpected increase of around 10 basis points, but he doesn't say what the implied increase in interest rates. So do you have an estimate, if you like, on what your quantitative tightening is doing into interest rates?
That remains actually around about the best estimate we have, 10 to 15 basis points in terms of term effects. Now, what I've said a number of times in this committee in the past, however, is to be very clear. Of course, when we set I'm not going to talk about monetary policy this afternoon, but I'll talk about the framework, if you like, if you don't mind, to be clear. When we set the official interest rate, bank rate, of course, we set it taking everything into account in terms of financial conditions, including that 10 to 15 basis point impact. So to be clear, it's not an add-on to monetary, it's taken into account when we set the level of interest. Now, at the moment, we are doing very little in terms of gilt sales, because we have this year a very large natural maturity of the portfolio. So we maintained the overall runoff at 100 billion for this year, but actually 86, 87 of that is just natural runoff. So we're actually not selling much at the moment. We're doing very few auctions relative to the past. Now, if I could just say, going to the second phase, when we get to the sort of equilibrium level, as I said in the lecture at the London School of Economics, we will then have a decision to take as to what we do thereafter, because we're not then trying to reduce the level of reserves, because we will have hit the natural level. However, we will have interest rate risk on our balance sheet, because we've bought gilts, and on the reserves we remunerate them at the prevailing bank rate. And as I set out in the lecture, my objective would be, over time, that interest rate risk should go back into the banking sector. It should not be on our balance sheet, and it should not therefore be on the balance sheet of the public sector. It should go back into the outside world. How quickly we do that to be decided. That will be the decision for the second phase.
Okay. I think you're trying to get to, Governor, is that in this, your regime, the Bank of England has active sales of bonds, and in Canada, the United States, they haven't done so.
Yes.
And at the very least, if you're winding it down quickly, it's a faster increase in interest rates. Yeah. And I would say on the term premium side, my understanding from the lecture of Dave Ramsden, and I'm happy to be corrected, but the 10 to 15 basis points about unexpected sales, not the runoff of sales, because whatever quantitative easing was doing at the beginning, you'd expect a symmetrical increase on the other side. Yeah. I'm not sure 10 to 15 basis points would add up to kind of what we would expect the impact of QE to have been in creation.
That's our assessment of it.
So I suppose the question for me is, the United States and Canada and the ECB are not doing active sales, but you are.
Well, can I explain the difference?
Yeah.
Yeah. So, let's take the US as the example, as you said. The US public debt stock has a much shorter maturity than the UK public debt stock. So when the Federal Reserve did its QE program, it bought very short maturity assets. The UK public debt stock is much larger. It's been a deliberate policy of UK governments for quite a long time to lengthen the maturity of the stock of gilts. So when the Bank of England started its quantitative easing program back in the financial crisis, the decision was taken that we would buy a stock of gilts which essentially matched the profile of the stock of gilts in issue. And that was deliberate, because we didn't want to start affecting the relative price of gilts across the curve by us being more in one part of the market than another. What that meant was that we've ended up with a much longer duration and maturity of gilts than the Federal Reserve. And so what it means is the Federal Reserve is in a position where it's actually having to take the reverse decision. It can just let these gilts, their stock will just naturally run off very quickly. And actually the decision they've had to take as they started on it is actually how much do you let run off, or how much do you throttle it back by continuing to buy short stuff to stop too fast a run off. We've had the opposite issue, which is that the stock is very long. So the stock would be with us in substance, for decades. So it puts us in a different position to your question about sales than many of the other central banks. Not some others. The Swedes, for instance, are selling as we are, but puts us in a different position to many others.
And then on the side of when you'll realise, I want to comment on what the kind of the impacts on the fiscal side are, right, in terms of what it's doing. You're actively selling bonds.
Yes.
If the base rate falls, the loss, if you like, the Treasury had to indemnify would also, if you like, fall through time. Is that correct?
That's correct, yes.
So by doing so at the moment, i.e. by doing active QT now, you are directly increasing government borrowing, but if you let them to run off just a little bit longer, there is, if you like, a fiscal saving. I appreciate indemnity is one thing, but I'm saying there is an impact.
Can we just be very clear that, of course, there is a balance here, because the longer we leave them, you've then got the cost of carry. Because remember, as I said earlier, we've got this interest rate risk. So we're remunerating reserves at bank rate. That's how we essentially anchor the short end of the curve for monetary policy reasons. Obviously, the gilts have, on the whole, because of when they were bought during the very low interest rate era, have lower coupons on them. So I would always correct this point that, well, if only you held on to these gilts, you wouldn't have the same cost. Actually, in an efficient market, it would balance out. You'd have the cost of carry, the interest rate differential, versus the cost of selling, and those two things have to be seen together to actually, in a sense, calculate the effects.
I accept there's the cost of carry. I think the market wouldn't be fully efficient, right? The way we would price it in. So I'm saying more broadly, like if I was to sell the bonds at the end of this year as opposed to the beginning, there is a possible fiscal implication that tends to reduce on the fiscal side of things, because what I'm particularly concerned about, I think I'll carry on or let others get onto this, but there are investments we have to make to protect our financial stability. I'm thinking about climate change. And yes. I suppose my worry is at the moment with the APF and quantitative tightening is, are you considering the ways in which your actions around this are reducing investments, both by the private sector as well as the public sector, and reducing those risks in the long term?
So first of all, 2 points on this. First of all, let me just make the point that, of course, if you spread out the profile of the runoff, I mean, you will have the same. You will have the same in an efficient market, as we were just saying. You'll have the same cost. You'll spread it over time. Now, whether you think that's a good thing or a bad thing, I think different judgments on that. But I just want to make the point: you don't change the actual overall cost over time. It comes to the second point, and here I think you really need to get the people in who are experts in government accounting, which I'm certainly not, if you don't mind me pleading on that one. How this affects government cash flow, and actually how it affects the fiscal rules is important, because obviously that is actually determined by the nature of the fiscal rules. The government made a change to the fiscal rules, you may remember, in the budget, in terms of how the stock of debt is calculated, including the debt that we hold. And so I'd say, I think if you don't mind me saying so, you'd want people who are much more expert than I am in terms of how those cash flows and the fiscal rules work to understand the impact of those actions on the overall fiscal position and on the constraints it has, because it's not as simple. I know I often read articles saying it's very simple, the cash flow is this. No, it's not, because it depends on how it works within the fiscal rule.
That's very kind. Thank you, Governor.
Thank you very much.
Well, it's kind of you to say that, because I'm
thank you. This question mostly for the Governor, but also possibly for Mr. Benjamin as well. The Governor just mentioned this phase 2 getting to equilibrium possibly in the next few years, or maybe you want to specify the timeline, Governor. At that point, the banks that are currently getting a much better deal right now, because the Bank of England and the Treasury is taking on all of the interest rate risk, will be asked to suddenly kind of have a bunch of risk that they might not want offloaded onto them. I was wondering what do you think this means for the banking sector and their response to that side of the bargain, as it were? Are they willing? Will there be a fight? How do you see that working out?
No, I don't envisage a fight on this front at all, actually. I mean, I think it is quite natural that, first of all, they have to choose the level of reserves that they think is appropriate. Now, it's not a completely free choice, because we have policies, obviously, on liquidity in the banking system, because we can't have it running. We've tried this in the past, and it ended badly to have it running at too low a level. But I think then, of course, it's for the banks to decide how they hedge the interest rate risk on the reserves, which they will do. So they will have a set of deposits with us, which they're remunerated at the bank rate on. They will have to decide what assets they wish to hold, and also, their asset is actually the deposit with us. Sorry, I've got that wrong way around. What rate they pay on the liabilities, but also how they hedge those positions, because they all have what I call structural hedges in place, which hedge interest rate risk on their deposit book and on their assets. Over a period of years, and they will choose to. And I think they agree with this. It's not a subject that really comes up much in conversation. The natural place for that to be managed is in the banking system.
Mr. Benjamin's nodding. Is there anything you wanted to add?
That's right.
That's good to know.
It's just agreeing with the Governor.
That's right. The only thing I would add is, gradually, as we return to this new normal, we'll see an increase in the use of our lending facilities, in our repo facilities, like the short-term repo and the long-term repo, and that is a feature of the new world that we'll be returning to. So that's a very healthy feature of that evolution towards that new norm.
Yeah, I mean, we currently have, I think, as of yesterday, it's about something like £57 billion of lending out in the repo market. Mostly it's short-term, but there's a there's a bit of longer term as well. So we are providing liquidity into the market at the policy rate. So we take no interest rate risk on that lending. That's the key difference.
Thank you very much. John Grady.
Thank you very much, Chair. I wonder if we should give the Governor a rest, and I wonder
that's a good idea. Yes.
Dame Collette or Ms Oakes would be willing to help me with some questions on geopolitical tensions. Now, 2.2 of the report, it says geopolitical and global fragmentation risks. Heightened geopolitical tensions pose a significant risk to financial stability. Has this become more or less predictable, would you say, since November 2024, noting changes in France and other large countries?
I'll take that and give
Colette.
give Colette a rest for a second. I think the geopolitical situation is complex. It has become much more complex in the last few years. It's very difficult in the early days of a new administration in the United States to predict precisely how this is going to play out. But I think we can all see that tensions in, whether it's in China and Taiwan or in, the Russia-Ukraine ongoing situation, continues to put pressure on supply chains, continues to put pressure on the cost of energy more broadly. And there are a whole range of different channels by which that transmits into the financial sector. Whether it's going to get any better or any worse is almost anyone's guess. And I think that's the challenge that we face, is trying to work with financial institutions and advise people, or at least identify some of these risks and enable people to take measures, or to actually at least look at the situation and consider to what extent are they exposed, to what extent is their environment and ecosystem exposed, and are they aware of all of the complexity of the environment in which they are operating in.
And how out of interest does the bank go about assessing this, which has become a lot more unpredictable, and there's a fairly short supply of true experts probably in this field? So how does the bank assess this risk?
Certainly, what I've witnessed, I'm an independent member of the committee, so actually relying on a lot of diverse feedback from multiple different sources within the bank structure. The international division, for example, reports back on measures that are happening, things that are happening that they see through their chain of conversations and inputs. There's also, from where I'm standing, a range of different segments of the bank that are looking at particular impacts at different moments in time. And I think that each of those areas, fundamentally, whilst it's geopolitical, it also has a different angle or lens to it, whether it's about the energy sector, or whether it's about, so different horizontals within the market. And we then look at it through a lens of whether it's impacting the insurance markets, the financial markets, where are those channels of transmission actually starting to materialise.
If I could, sorry to interrupt.
Thank you, Jane Colette.
Could I just add to what Liz Oakes has said? Liz has talked about the political threats and so on. There is another side to this, which is, as you know, we operate within a quite complex series of global institutions. And right at this moment, what we can't see and what we don't know is whether those institutions are going to continue to be robust in the light of all these various geopolitical, etc., tensions that Liz has mentioned. So that's another thread in this that's quite an important one.
That is a very important thread, Dame Colette, and I think my colleague Mr. Glenn will pick up on some of those themes in a moment. And with this ever more complicated background, how does the bank keep under review whether it's assessing these risks in the right way, or whether there are better ways of assessing these risks?
Well, as Liz has said, we have a range of sources of advice that we, within the bank, that we take. We also, as we are external members of the committee, of course, we all have our own sources of intel, if I can put it like that, which is one of the things we bring to the committee. And so our job is really to be constantly, if I can put it like this might seem a bit sort of obscure, but our job is to be looking at what's going on in the tail of the distribution of probabilities. And that's the job of the whole committee. But as external members, we feel that's very particularly our role to say, well, hang on a minute, have you thought about that thing over there or that other thing over there? So, frankly, at a moment of great complexity like this, there aren't quick, simple answers that say, well, this is how it's going to pan out. I think our job is to make sure that we've got our heads around the the range of possibilities.
And then a final question, which is completely unrelated to international matters. The FPC has an outstanding recommendation that the pensions regulator should have the remit to take into account financial stability considerations on a continuing basis. Has this been acted on? I wonder if that's a question for the Governor.
Well, we can't act on it. I mean, I'm afraid. So it is a recommendation to others. So the situation is, and this goes back to the previous government, when we originally made the recommendation, the previous government said that they agreed with it, but it requires that then to be put into the objectives of the pension regulator, which is not something we can do. And it hasn't been acted on, so that's why it is an outstanding recommendation in that sense.
And thank you, Governor. Would you be able to shed any light on why this hasn't been acted on?
I can't speculate myself as to why this is the case. As I say, we have had to go. And by the way, look, I would also say that we've had a lot of cooperation. We've worked very closely with the pension regulator, particularly in addressing obviously these are the issues that came out of the liability-driven investment issue of a couple of years ago. Well, just over a couple of years now. And so, to give you an example, I mean, now the sort of the buffers that these funds maintain have been increased. We work very closely also with the overseas regulators because it had a particular relevant. Many of these funds are in Luxembourg and Ireland, so there's no shortage of cooperation on that front. What I would say, however, is that we felt that it was important to embed the objective. So it was agreement, but it hasn't happened yet.
Thank you, Governor. Thank you, Chair.
Rachel Blake MP.
Thank you, Chair. Reflecting on Dame Colette's remarks about focusing on the different ends of the probability curve, I want to come on to public sector borrowing and how you have assessed the risk of public sector borrowing on financial stability.
Just thinking about how to respond to that without getting into the areas that the Governor said at the beginning we were not going to talk. I'm sorry if that sounds really disrespectful to this committee.
We understand your opinion.
I'm sure you all understand the sort of box we're in because of the timing of this hearing. So I'm really sorry to have to say that, Ms. Blake, but I think there's not a lot we can say without getting into that rather difficult area. You're going to disagree with me now. That's good.
No, let me offer a bit
this
of...
is good.
I'll offer a primer and you can take over.
We don't have groupthink, you see. This is good.
This is a point not unique to the UK by any means, because actually when you look at... and we've said this in the Financial Stability Report, when you look at sovereign indebtedness, actually what we've seen in many countries is an increase in public debt. Now, there are, I think, a number of very substantial, what I call structural headwinds in the current world. And I think three of them I would pick out. One is that the UK, like many, well, like actually all other industrialised countries, has got an ageing population. And that has an impact on a whole raft of public policy issues. And it does have, I think, an impact on aspects of public debt. So that's number one. The second one I would observe, I don't think it's controversial at all to say this, is that I think the sort of the post-Cold War dividend in terms of defence spending, sadly, is not there as it was for reasons I think we all know. Thirdly, I'm not wishing again to embrace any controversy from sort of changes in other countries. And recognising that this is very much not all. This should not be a full burden on the public sector. There is obviously the cost of climate change that goes with it. Now, I say that because I think all of those three things are very big structural headwinds that we face. Before you get onto any, I'm not going to comment on the politics of this. I think those are important points which have to be managed. And I think, frankly, if we had any one of those three at any one time, we would have a substantial issue on our hands. And we've actually got at least three of them at the moment. And so I think, I'm hoping this doesn't fall into your trap. I would say that I think, and when you think about public indebtedness, we have to think, therefore, about how we sort of structure it going forwards, thinking about the impact of these structural factors. I would also say that I think some of the long-run projections of public indebtedness do rather simplistically assume that it's just going to sort of, they sort of get the ruler out and sort of extend that. I think clearly very big decisions are going to have to be taken about it, because of course if you take that sort of ruler-like approach, then you will get huge levels of public indebtedness a long way out into the future. But that seems to me to be making very big assumptions about what public policies are going to be. So, I would put it into that. I don't think that gets us into monetary policy, and I think we're very careful about not wishing to comment on fiscal policy. But I think recognising these headwinds is important. It's not controversial, I think, in that sense.
So to follow up on that, am I right in understanding that you don't think that public sector borrowing is just heading in one straight line direction, and therefore your assessment of the impact on financial stability is more subtle and more iterative on the?
I think yes.
In response to that.
First of all, I mean, look, we have to we always operate as the Bank of England on the basis that we take stated government policies. Given the Chancellor, I think, has been very clear on position on fiscal policy, and that's the basis on which we operate. I would, as I said, I think there are structural headwinds that fiscal policy makers in all countries are having to deal with. The second thing I would make, and this is a financial stability point, and Nat may want to come in on this, because it's why we did the system-wide, one of the reasons we did the system-wide exploratory scenario. What we have seen is very big changes in the way financial markets are trading and position taking in government debt. So there is much more hedge fund activity in government debt, much bigger positions are being taken. And because of the size of these positions and the potential that if there is a very big shock, they may get suddenly unwound, suddenly the world changes. We're very focused on the fact, and why we did what we think is a sort of world-leading exercise here, to say, at what point does financial stability become compromised by these changes in activity in government debt markets? But you may want to...
That's right. One of the ways in which pressures on sovereign debt can feed into financial stability is in that it can cause volatility in financial markets, in markets that are core to the economy. And that volatility can then be amplified, as the governor said, by existing vulnerabilities in market-based finance, in large leverage positions, for example. And those amplification effects is what we wanted to test in calm times to understand how the ecosystem would behave and would respond to those shocks and had the potential to amplify them. And that is why we ran this exercise, to test those particular effects. And it was very insightful, very instructive, both for us and for the market participants, because we found things that we didn't know before. And we also found that some markets were more resilient than they were before. Like the gilt market had improved, has strengthened its resilience. But we also found that, for example, the gilt repo markets may run into some capacity constraints, and the sterling corporate bond markets may hit some forms of illiquidity. All those learnings, it's very important that all the participants in that exercise factor them in their internal risk management, so that should those shocks happen, they're prepared to manage them and to deal with them. And the only thing I would add is, in this exercise, one of the pioneering features was the flow test aspect of it, which is we did not assume the behaviors of players in those core markets. We actually asked them. And we checked the extent to which the assumption of certain market players were consistent with the reaction functions of their counterparties. And we reconciled, well, actually, you assume something that will not happen. We told them. And that is the type of things that help them sort of improve their own preparations and risk management for if those shocks do happen.
Okay. Thank you. I wanted to perhaps come back to Liz Oakes or Dame Colette around the relationship between growth and financial stability. We heard from the Governor about different categories of where there might be changes and opportunities to pursue growth in a balance and alongside financial stability. Were there any more changes that you anticipate from the remit?
I think even before the remit, actually, because I've just joined the committee in the last 6 months, one of the things
just
I observed...
before the election, wasn't it?
Yes, it's literally just as the election happened. One of the things I've observed is actually, as an external member, being able to ask those questions around consultation with, market participants around so how the consultation is conducted, and what do we ask them, and do we ask them the right questions, and are we actually asking, what is the cost of the regulations or the cost of the change, and also the complexity of the change, because sometimes when we introduce changes that perhaps within the bank are perceived to be quite straightforward, within a financial institution and its ecosystem might not be quite as straightforward. So that's certainly been one area where I think it's valuable to continue probing all the time as to how are we thinking as market participants would think around the changes that we're proposing to make. I think the other side of it is around what the Governor referred to earlier around strong and simple. I'm very much an advocate of reducing complexity where possible. So to encourage new market participants or to encourage existing market participants to expand competition in a particular product set or a particular area of the market, they have to understand how complex it is to participate and what's involved in getting into that particular area of the market. And I think that's actually quite difficult. As an outside observer, if you have to navigate, what are the rules involved, whether it's the PRA, the FCA, or the raft of different regulatory authorities we have, and that's just in the financial markets. I think when you look, my background has been in payment systems. When you look at things like open banking and open data and open finance, quite often there's a convergence between other regulated sectors of the broader industry and market. And so it's actually very difficult to navigate, what are the rules required perhaps in the telecom sector at the same time as the financial sector, and what's the crossover. And so that level of complexity and compliance overlay that exists now in order to participate in the market is complex if you're based in the UK. I think if you're also then looking at new entrants or foreign direct investment from other participants who would seek to come to the UK and compete or to expand into the UK, that's really complicated. So those are the kinds of areas where I think it's valuable to continue to probe and to ask those questions. They're not easy things to change, I'm sure you'll appreciate, and I certainly see that the work that's been going on, which I think Sam Woods referred to when he came to speak recently at Parliament, was around simplifying some of those data requirements, data reporting, and the Governor referred to data reporting earlier. Data reporting is probably the tip of the iceberg.
Rachel Blake. So you talked about the telecoms overlay and the relationship between those kind of regulations, and how might other sectors experience the same challenge of overlay? Are there any other sectors that might face that challenge?
Certainly with things like open data, just the regulation of data, so people's personal data. So the fact that you've got multiple regulators, for me, open banking was a very clear example where you actually had the data regulator responsible for one aspect of people allowing open access to their personal information and transactions, for example, that they conducted, or their banking information, whilst at the same time you have a financial regulator obviously responsible for regulating what happens with financial data. But quite often it's very challenging for a financial regulator, for example the FCA, to look at the business model of an entity that perhaps they've created an app for you to improve your fitness or improve your diet or something, and it happens to take the data from the last food that you purchased, and the receipt data is examined, etc. The crossover there between financial regulation and people's personal information or medical information is quite unique and quite complex. For the FCA to try and navigate that and figure out how that works, I believe is quite
And does the responsibility for doing that lie with the FCA on the basis of the change in the remit letters, or does it lie elsewhere, in your opinion?
Historically, as a result of EU legislation, it resided with the FCA. There is an element of it that resides with the data regulator, but it's typically the business
really,
model analysis is with
it's
the
these
SEO.
crossover areas that are one of the challenges for growth, do you think?
I think so. I think it's the complexity, and it's not that we've deliberately set out to make it complex. It's just the nature of when you open up the floodgates and you say, okay, we're going to do open data, it's fantastic. You see all this innovation with wonderful new companies coming in and saying, oh, look, if I have that data, actually I can do something really new, quite groundbreaking with it. But we haven't figured out exactly who should be responsible.
Could I just add one short supplementary on that specific issue? On the open data, open banking thing, is it not the case, though, that there is a massive imbalance of power in the industry between incumbent banks who are very reluctant to actually open up, and lots of new players who are very keen to gain access to that? And surely that's the heart of it, and we've got to grip that.
I think I see both sides of the argument, probably because historically we didn't expect banks to do anything with the data. In fact, we gave them a fiduciary responsibility to protect the data, and certainly personally I don't want my bank sharing what I do every day, and I'm pretty sure that the vast majority of the population probably doesn't either. But then when you ask people, okay, but would you like this app that tells you about your fitness and your what you're eating? And so in order to get to that, I need to do X, Y, and Z. I think sometimes we're on that path of discovery and figuring out, okay, so how far can we go with this? And there are some boundaries that are very, very clear. For example, with medical information, if you went to a pharmacist and purchased medication, you certainly wouldn't want your bank to be selling that data to an insurance company that would then determine that you had something, a terminal illness, for example. So there are a lot of things where actually thinking through the logic of the customer experience, the data experience, what does that actually mean, and where are the risks and liabilities, is something that is almost being done as a test and learn process as we evolve this environment. And so there is an element of how fast can you go, and it's not an area where you can go fast and break things, because some of this data, once it's out in the wild, you cannot contain it again.
Thank you.
Huge opportunities and huge threats. Yuan Yang MP.
Slightly jumping back to the discussion that Mr. Benjamin had just then on stress tests and on gilt market volatility. I just saw that yesterday you'd opened your new lending facility for non-bank financial institutions, so insurance companies, pension funds and the like, in times of severe gilt market dysfunction. I was wondering if this is, how much of a first this is for the bank to start having lending facility to non-bank financial institutions, and what risk you saw for making that first step. And secondly, it'd be great to just get a bit of the background on where the idea for this had come from and kind of the origins of this, of the need for the new facility.
So I think this is indeed a first, and it's a great new tool that we have in our toolkit, and it is the first time that we equip ourselves. So this would be, we're now open for applications for this new tool, and it means that this would be a way for us to have the ability to lend directly to pension funds, insurers and LDI funds if we decided that there was a severe dysfunction in the gilt market that justified us taking liquidity directly to that corner of the financial sector in order to avoid asset sales, for example. So this is a great additional tool to have in our toolbox, and it's for situations when we think there are dysfunctions that are so severe that only we can restore functioning of those markets. So it's great to have that tool in our toolbox. It is a tool for us to decide when to activate, and that is how it would be used should that be required. But it is a great addition.
Can I make a couple of points on that? I think it's really this is very important. It's a great question. The first one is this. Historically, and this is a sort of canon law of central banking, we only provide liquidity to the banking system, and we expect the banking system to distribute that liquidity to wherever it's needed and for it to happen. So you might, and this sort of goes back to Walter Bagehot in the 19th century. Now you may say, well, so why have you made this change? I mean, this is quite fundamental. I mean, somebody raised an article saying, Walter Bagehot would be turning in his grave. I actually don't think he would, because I think he'd realise we had a problem to deal with, which he criticised the Bank of England for not doing in the 19th century. But the point I want to make is this. Going back to the exercise we've done and what we've observed is that I think the growth of non-bank activity and the growth of this position-taking activity is now so much so, we can't rely on an assumption that the banking system will always get the liquidity would always get to where it's needed via the banking system, and that's really the crucial point that sits under this for why we've made the change. So first point. Second point, briefly going back to the liability-driven investment episode, but it's relevant to the questions you're asking about growth, actually. Colette mentioned the question about the tail of the distribution of sort of bad things. Regulation can obviously is designed to cover quite a large part of the tail of the distribution of bad events. But if you set out and said to me, why don't you cover the whole tail? I would say, well, we don't actually know, we don't know how big this tail is, and it will reduce to very small probabilities of really bad things. I think to design regulatory systems that would cover all of that right out into the really far reaches of the tail would be very costly and inefficient. So there is a natural boundary where you say, actually, we have to use other tools at that point, and the other tools are central bank intervention at that point. So there is a role for it. And the reason I say this is because in thinking about regulation, and in thinking about what happened in the LDI incident, where you draw the boundary between saying it makes sense from a cost-benefit point of view to say regulation covers this amount, beyond that, actually, it might be more efficient for you as the central bank to come in if there's an emergency and do these things. That's an important decision to make. I'm not suggesting that we deregulate to the point where you assume the Bank of England will just come in any old day and mop stuff up, because that's not efficient either. It creates all sorts of other issues about moral hazard, for instance. But there is an important boundary to be drawn here, and putting this facility in place helps us to deal with that far end of the tail of events.
I was wondering if you could play out as well, because obviously this is for severe dysfunction and not something that you'll use day to day. What would it look like in terms of timeline and who makes the decisions about intervention if it were used, and would there be
coordination? Well, and that made the key point. We've had to, for the banking, obviously the banking facilities we run, I referred earlier to the repo operations. They are available every week, and banks can come to us and bid for liquidity. In this operation, as Nat said, we are not opening ourselves up and saying to non-banks, you can come and get liquidity from the Bank of England whenever you fancy it. As Nat said, only we would decide when it's available, so we would decide, are we now in an emergency that is such...
I'm just trying to ask, how would you decide?
Yeah. Well, we would have to assess the conditions. And
we monitor markets continuously.
Yeah, it's this point about dysfunction in markets. Are we now at a point where we don't think the natural distribution of liquidity is going to solve the problem?
Are you saying it's a judgment issue? Or,
it's a judgment. Yes, it is.
So it's you don't have a sort of set process you go through. And
no, we have a lot of process behind it.
Yeah. Are there any instance in modern history where you think this would have? I know you talked about 19th century.
Obviously, we did it with LDI.
Yeah. That's the obvious reason.
But we didn't have this facility. We had to sit in the middle of the night and with a whiteboard and cook it up. And so we decided, coming out of that, we'd be, it's much more sensible for us to have this sort of, there when needed. But it's not it's not what we call a standing facility in the sense that it's always available. It's only available if we think the conditions require it.
Okay, thank you. John Glenn MP.
Great. Well, I think I've got three questions. One talking about domestic things, one about international, and one about this issue of the tail. If I could start, Governor, you helpfully set out some of the things over the last few years that you've done. So strong and simple changes to help the smaller banks, the Solvency II changes to create more pools of capital to be invested. I think in your letter to the Chancellor, you also talked about the FPC's decision a few years ago to withdraw the affordability test.
Yes.
And insofar as this committee is trying to create a sort of a bridge between our constituents and quite complicated regulation, one of the things that has been speculated about in recent days is what more can be done in the mortgage market in terms of removing the stress test as well. It is speculated about, and I'm not, I had this too. What is that a way forward? Does it open up a growth opportunity in the world that we live in now? The question behind it, I think, is that historically we've been too conservative, and we're now 17 years away from the financial crisis. It's time to be a bit more reasoned in that.
Can I paint the opposite picture and then sort of, in a sense, by doing that, set out the very sensible challenge you put down? So we've been through some very big economic shocks in the last 5 years. COVID, Ukraine. We've raised interest rates from sort of basically 0 to 5.25%. And what has not happened? We have not got large arrears in the mortgage market. We have not had housing repossessions in the way, if you go back to the financial crisis, if you go back to the early 90s, we have not had people having their houses repossessed. And I don't think we're creating a legacy of mortgage prisoners, sorts of things you and I had to talk about in the past when we were in different roles. That's a good thing. It's a good thing. Now, the question then is, to your question, is where do you strike the balance between the two? I think the rules that were put in place on this front, and the FPC's affordability test and the FPC's loan-to-income ratio policy have helped in this respect. I think they've helped to avoid the creation of a large tail of mortgages, which, when we have the inevitable cyclical downturns or shocks that hit the economy, turn out to be a real problem of the sort that we've seen in the past. So I think that has been beneficial. Now, does it restrict entry into the mortgage market? Interesting question. We actually haven't seen a decline in first-time buyers in the mortgage market, either as a proportion of the total, I think, or in aggregate, actually. But I think there are people who do come forward and say, I can't afford to get into the housing market. There's clearly people in that position. There are clearly people in the rental market. I do meet them when we go around the country doing panels. So I'm very open to this question about the affordability test. We, by the way, dropped our test because it really it overlapped with the FCA's test by such a large part that, again, it was a good example of where regulation was inefficient. I would say, look, I'm very happy to have a very open public debate about how you balance getting these better outcomes in terms of people not having their houses repossessed and so on with the effects the regulations have. I think that's the debate we should have in thinking about, where's the right place to put regulation.
If I just follow up on that quickly, if there's a stress test which implies that you've got to have a margin above the prevailing base rate, right? That still exists. But if you've got a higher sort of renormalised base rate now, is that artificially high? And I mean, I realise this is the nub of the issue. You're not going to tell us now, but the point is, everyone was lobbying me during my tenure in office, and will be saying it again now. Is it not time to look at that again?
We do review the tests quite frequently, and we will do it again. I mean, because actually we review this part of our framework more frequently than any other part. For the reason, to your point, really, is that this affects people very directly. So we're very conscious of that it needs to be reviewed. I'm very happy to do. We will do that. I'm not sure we haven't set the date, have we?
No, that's right. I mean, if I may,
we'll do it certainly.
A couple of things. I mean, as the governor said, we removed in 2022 the additional affordability test that was in place. That was we judged it was not necessary. Very recently, in terms of the other test, the loan to income test, we lifted the threshold above which it applies, which means that now more lenders are exempt from that limit. Importantly, in terms of that loan-to-income test, there is still plenty of headroom within that limit, which means there's a large number of mortgages that still can be lent on a flow basis within that limit. So that isn't a barrier. And I think we have, as the governor says, we have been keeping all our tools under review on a regular basis. But in terms of affordability, we've already removed the one that was in place. One thing I would say is that if there is a material increase in the number of new mortgages that are granted, if that does not happen at the same time when there's an increase in the amount of new homes that are made available, the risk is that the immediate effect will be an increase in house prices, which will make things even more difficult for a household to get onto the housing ladder. So those two things need to be considered in the round. And finally, in terms of first-time buyers, it is right, I mean, to pick up on the point from the governors, if we consider the stock of new mortgages, and within that stock, the proportion of those given to first-time buyers, that proportion is at its highest level now since 2005.
I just say, to reinforce what Nat said, in all the sort of the surveys that are done, when you ask people what is the major impediment to getting into the mortgage markets, it's affording the deposit.
It's the deposit.
Okay. Can I move on to a second question on the international scene? Now, obviously, I think you've sort of collectively said there's a degree of uncertainty over what US friends will be doing. But we've seen some really tangible changes. This 82 billion of gold that's been shipped to New York, that the traders are waiting several weeks now rather than a few days to access their gold. There's also a live discussion about how loosely or what the forward moves will be of the US regulators in terms of financial regulation, in terms of the delay to Basel 3.1 implementation. Can I ask you, what do you see in terms of consensus or not in terms of international attitudes to banking regulation? With that delay in the Basel 3.1 implementation, as I understand it, you agree at a global level and then each jurisdiction makes their own interpretation, but you're anxious to do it in a way that is competitive with the other jurisdictions. No. How do you see the risks and what do you see as the path through this? You're obviously a very experienced player on the international scene, Governor.
Yes, and I'm very heavily involved in the Global Financial Stability Board, so this is obviously a very major subject. So first of all, Basel serves two purposes. It is, as you said, it is the prudential regulatory framework. But in being that, it is also, of course, the basis for competition. I mean, it provides the sort of the level playing field, if you like. So it is very important, and I would stress this to all those involved in this process, that it's not just about regulation for the sake of regulation and prudential standards. It's also about creating a level playing field for competition. So it is important. We don't know yet, I mean, where the new US administration is going to go on this because the key appointments are not yet in place. So we don't know, and I think we need to give them time to do that. It's important to let that happen, which is one reason why we took the decision we did which we announced a week or so ago. But what I would say, and I will be saying, is look, Basel is very important for the two reasons I gave. And when I talk a lot to institutions and banks in the US, they do understand this. I mean, it has become controversial in the US. There was controversy around the Federal Reserve's original proposals for implementing it, which, I mean, when you started seeing adverts on television about Basel, I realised we were slightly in a different world.
Like with Solvency II.
Everything becomes mainstream at some point.
Well, there was that famous debate amongst candidates to lead your party, which got on Solvency II one evening on television, and I thought this really is a surreal world that we're living in. But much though I love Solvency II, really. But look, I mean, what I do hear, though, from the banks is that they do understand this point, that they want it to be done because it provides the basis of competition and basis of a level playing field. So, in that sense, I remain optimistic that we'll get agreement on it and we'll get through this. But I think, to be fair to the new US administration, we have to give them time to get into place.
And my question on the 82 billion stockpile in New York of gold and the changes in behaviours we're seeing in anticipation of tariffs or not. How do you view that?
Well, I don't really. Please, I mean, this is not a big thing, really. I think. I mean, it maybe. First of all, of course, gold doesn't play the role it used to play. So if we'd been having this discussion 100 years ago, we'd have been in some very different world because we were on the gold standard. We're not on the gold standard anymore. So it doesn't have a significance for policy in that sense. there may be some, as you're implying, some anticipation of, some effects around tariffs or not. I don't know. What I would say is that London actually remains the major gold market in the world. It's the world's leading gold market. If you're involved in that market and you want to trade or use your gold, you really need to have it in London. So gold does flow in and out of London, though. We'll see, but I don't want to sort of, in a sense, dramatise this story because, so gold does move and it doesn't play the role it used to play.
Thank you. Can I turn to my third question, if I may address it to Dame Colette BoE? You talked about, I thought it was a fair way of presenting it, you're concerned about the tail, and the governor's talked about insuring against the whole of the tail, but one of the concerns that perhaps people in financial services would say is that our regulatory framework and institutions, including yourselves, would be so focused on the tail that it wags the dog, if you like. It changes the sort of fundamental sort of level of sort of regulatory sort of normalcy against competitiveness and growth. Now, when I was a minister, I didn't really accept that, but I was always having to raise that challenge. What can you say about us in the UK with respect to how we quantify and make real the coverage, if you like, of the risks in our financial services sector?
Okay, so when I'm talking about the tail, I'm not talking about dogs wagging them. I'm talking about distributions of outcomes. So just to make a sort of Bayesian point there for a moment, if I may.
You see, clarity of communication and the way we can make this real to the people that watch this is important, so thank you.
Thank you for that correction, Mr. Glenn. I accept
Not really.
it. So we're talking about, if I may, two slightly different things here. When I was talking about the tails of the distribution, what I was talking about is the role of this committee that we all sit on, where our job is to think about the unthinkable is maybe sounds a bit a bit over the top, but we've all lived through a period when the unthinkable nearly happened, and it's our job to not forget about that, to reflect on mistakes, failures of apprehension that our predecessors made in 2008, all very well documented. So part of our job as a committee is to think, what if? So that's one thing. I think your question is more about, is the sort of thrust of regulation to focus on things that are very unlikely to happen and to try and, stop them happening. And it won't surprise you to know that I don't accept that as a characterisation of the work that the bank and the other regulators do. I too have worked in the financial services industry, and I think although there were quite a lot of times when we felt that things like the requirements about the capital of the firms that I was associated with were maybe excessive, that was really where the focus was. It wasn't in the kind of work that the FPC does to, as my colleague Nat was saying a few minutes ago, testing the resilience of the whole system. As you know, when you're working in one institution, you tend to think about, all these onerous things we have to cope with. Our job is to think about the system as a whole. And as Nat has described, one of the things we have to do is test the resilience of that system as a whole. Now, if you're sitting in the system, you don't necessarily like that very much, but frankly, we're here as you are, to act in the interests of the people of the UK. That's our job.
Thank you. Can I?
Sorry, here endeth the first
question.
question.
No, that's fine. Thank you.
I just want to quote Tony Blair for a moment, if you don't mind. Don't
certainly don't.
That's all. Because I tell you what. I thought you'd start laughing at this point. I don't think he would mind me saying I actually personally know him very well, but who I'm saying, I mean, he in many ways, made quite a number of speeches, and there was quite a bit of policy intervention before the financial crisis in favour of light touch regulation. The reason I'm quoting him is one of the things he said actually after the financial crisis had happened was, well, if the regulators had actually laid out the risks and laid out I would have responded. And I think I take him at his word, I think he's right on that. The reason I say this is because it is very important. It's right to have this debate about the balance between growth and regulation. What I think our key job is to lay out the risks and the vulnerabilities so that, you said not only the public can see them, you can see them, you can hold us to account as to what we're doing, and we're in a sense pushed to explain ourselves and say, this is what we think the risks are, this is what you need to know.
Yeah.
It's really important that we do, it's really important that, and I don't think it is, by the way, but it is, that is not inhibited.
My final question, if I may, Chair, is the interaction between yourselves, what you do in terms of the stability and sort of systemic risks, and the FCA. Because I think for many people, they will hear that the government has asked the regulators to come forward with ideas of things that can enhance growth. Clearly, you underpin some of those decisions. Could any of you say something to help us clarify the relationship between your work and that of the FCA, and what happens if there's, say, a difference of opinion as this imperative for regulatory changes to induce growth becomes more intense? Mr. Benjamin, would you like to respond?
Yes, I would. I mean, we've got a very close working relationship with our colleagues at the FCA, and indeed Nicosia, the CEO of the FCA, has a seat on the Financial Policy Committee. And I would give two examples of that. The first one, we talked about our stress test. Specifically, we run this first-in-kind system-wide exploratory scenario. We did this in partnership with the Financial Conduct Authority and the pension regulator. And there's an entire complete confluence of interest, given that they oversee and supervise a number of players in the non-bank sector in finding out what the risks are. And as the governor said, surfacing what the facts are so that everyone understands what they, and so that the market itself can prepare for shocks. So that's the first angle. Great collaboration with our colleagues there. And the other one is what we were discussing before, is in terms of mortgages and households, and we have a very close working relationship on that side of things.
There won't be any arbitrage between you. You're collaborating on an ongoing basis.
Thank you very much, Mr. Glenn. You and Jan, just a quick one.
Yeah, I just wanted for Mr. Benjamin to go back to the scenario that my colleague John Glenn kind of illustrates about how regulatory focus on the tail can sometimes change the behaviour of groups in the main. For the new non-bank lending facility, what would you say to the kind of concern that for hedge funds, which, as the governor said, have taken large positions in gilts, that they have a kind of win-win mentality where there is no kind of downside risk and there is significant moral hazard for those hedge funds?
So just to be clear, the facility is open for applications for insurers, pension funds, and LDI funds. Okay, that is it for the time being, and it is. I think it is clear that, as you know, we regulate insurers. The Bank of England, the PRA, regulates insurers. In the case of pensions and LDI funds, there has been a substantial strengthening of their own liquidity buffers on the back of the LDI episode. So, the counterparties of the bank have some strength in that particular case. So, the scope of the new tool that we have is for that segment of the non-bank population, and we will keep things under review. We will be informed by the system-wide stress tests that we do, but at the moment, that is what it is.
Thank you.
I should also say this money will not be cheap, because to go back to Walter Badgett, I mean, he said, you lend at a penalty rate in these circumstances because of exactly the point you make.
Thank you. Stephen Harrod, Baldwin MP.
Thank you, Chair, and I want to get back to the subject du jour, which is growth and the Chancellor's speech. And there was something very striking that you said right at the beginning, Governor, about the way in which growth in this country has been at a slower pace since the financial crisis, as if you were kind of pinning some of the blame not only on that, but also perhaps on some of the steps that have been put in place since then, because it made me think of a phrase from the Chancellor's Mansion House speech last year, where she said that the reforms to the financial regulation post-crisis have resulted in a system, I'm quoting her directly, which sought to eliminate risk-taking. And she said it has had unintended consequences that we must now address. So I'd just like to ask each member of the panel to name an unintended consequence that you think you are now addressing, starting with yourself, Mr. Benjamin.
So I would think the way I would think about this is in terms of the benefits from a growth perspective of the measures that have been put in place, in terms of the number of shocks that have happened over the last few years, which the UK financial sector has been resilient to. And there's been a number of them, a number of foreign banks have failed, for example, foreign hedge funds have failed, and yet that hasn't affected financial stability in the UK, and therefore it hasn't affected growth in the UK.
I agree with the Chancellor that there's been unintended consequences, because I would argue that sounds more like an intended consequence.
So that is definitely an intended consequence.
Can you name one unintended consequence?
I'll have to think about it.
Ms. Oakes.
Thank you, Dame Harriet. I'm also racking my brains to think of an unintended consequence.
Governor, can you think of what the Chancellor might be referring to in terms of the unintended consequences from the changes that were put in place after the financial
crash? Well, I'm not sure, to be honest, I'm not sure to what extent the Chancellor is referring to financial regulation or regulation. I mean, she was making a comment, I think, about regulation as a whole, so I don't know quite what she had in mind at that point. Can I also start by saying, when I made the comment you referred to, look, I don't think regulation is innocent. However, I have to say, and the reason I made that comment very deliberately, I think the financial crisis itself is actually far more responsible for the cause of low growth than the response to the financial crisis. I mean, we had stronger growth pre-financial crisis, but it was unsustainable in some respects. I'm afraid I think the financial crisis damaged not only this economy, but other economies very badly in that respect, and we've had to respond to it. I mean, I think it's hard to pin, precisely consequences of regulation in terms of growth. I think one of the, Chancellor has spoken about this, previous Chancellor has spoken about it, I've spoken about it. The question of pension funds holding risk assets is an important one. The UK pension funds, two things. One, hold a low share of risk assets compared to pension funds in other countries. Secondly, over time, the proportion of risk assets that UK pension funds hold has declined a lot. Now, I'm not sure regulation is, well, certainly not the only reason for it. It might not even be the major reason for it, but wherever the reason for that sits, it's something that I agree with, say, both Mr. Glenn when he was in government, previous Chancellor, current Chancellor. We really have got to address this. This is important.
So what I'm hearing is that that's less the financial regulation reforms and more changes to the pension regulations. And I'm just,
well, there are. I mean, but I mean, obviously, certain parts of the pension industry are regulated by financial regulators. So we're not outside that world here. I mean, there are consequences of financial regulation in that world. I mean, obviously, we're very aware of that point. So I think we might be in the mix in that respect. We're not the only thing.
They weren't particularly things that were focused on post-financial crisis. It was post-pension funds crisis that.
Well, obviously you had things like equitable life if you go back in time as to what's driven. I mean, if you look at what's driven insurance regulation, it's probably more that than the financial crisis itself.
That was and Dame Colette.
Yeah, thanks, Dame Harriet.
Unintended consequences, what I'm after.
What I find a bit difficult in this bit of the discussion is attributing consequences to regulation. And I say that because, again, as we all know, what happened in 2007-8 was a kind of horrendous collective shock to the nation, to companies, to people in financial businesses who thought they were all doing the right things, and it turned out they weren't. And I think it's quite hard to attribute what might be a decline in risk appetite solely to regulation. because actually, you know, people have been scarred by seeing the consequences of excessive risk-taking, you know, 120% mortgages with no evidence of income sort of thing, you know. The kind of things have really happened in the run-up to the crisis.
So I'm not hearing a very sort of wholehearted agreement with what the Chancellor said in her Mansion House speech, that she felt that the reforms to the financial regulation post-crisis, which included establishing this committee, have resulted in a system which sought to eliminate risk-taking. I'm not hearing a lot of agreement
I think
between you with the regulator.
Well, let me come back to
I think
one of the most difficult areas, and I'll go back to my experiences at the FCA, is what is the approach to regulating investments, and how much risk do we expect investors to take? I mean, I've sat in this room and other rooms and had some quite difficult sessions with this committee in my past life over this, what is the expectation of risk-taking and investment, and what is this regulatory system there to protect against, and have we got the boundary in the right place? And I would say at the moment it is, there is quite a questioning of whether the boundary is in the right place, and whether the effect of the boundary being too far into the protection world is actually inhibiting investment. Now, I think that's a very important question. I think we need to try and, as a public policy matter, so this is both of us in a sense collectively, reach some consensus, because we've got to give a very clear message to the public on this. But I think that's an example of somewhere where I think it's very, your question's very right. We can have a very reasonable questioning at this point.
Thank you. I think we've heard one unintended consequence.
Well, it's quite a big one, actually.
People will be aware of my obsession with the advice guidance boundary as well, in terms of the potential unintended consequences that has had. But can I raise, because the previous Chancellor had set out a range of reforms in Edinburgh which were underway at the time of the election, and I just wondered if the committee has a view on where we've got to on, for example, ring fencing and the review of the ring fencing regime. Is that something that's likely to change, or is just been
Mr.
reviewed?
Benjamin seems to have something to say. Mr. Benjamin.
So the ring fencing regime has been reviewed recently and has been adjusted. That's completed, and there's been a few adjustments to ensure it remains proportionate. So that's been done.
Moving on to cryptocurrencies, obviously we heard about the change in terms of some of the mood music from across the pond on cryptocurrency, and a very, very clear steer from recently inaugurated President Trump that they are not going to have a central bank digital currency. But I think it's still something that the UK is developing a blueprint for. And I just wondered, from a financial stability point of view, whether any members of the panel would like to comment on whether that has any implications. Could there be a crypto boom or bust?
I would. So on last a year ago, the Financial Policy Committee took stock of the state of development of the crypto asset ecosystem, and watched very closely two things, and we're monitoring this all the time. One, the size of that ecosystem, and two, the degree to which it is interconnected with the core of the financial system. And when we did the assessment last time, we found that on both criteria, there was not enough of a total size and degree of interconnection for this to, at the time, pose a threat to financial stability. But we made it very clear that this is something we are tracking and monitoring very carefully. So, for example, one of the recent developments is now institutional investors have a way of taking exposures to regulated crypto activity via exchange-traded products, for example, and there's been some pickup in that. So that is an example of something that is small but increasing in terms of interconnection between the crypto world and the main sector. But so far, our assessment is still that that risk isn't there, although the connections are increasing.
Okay. Anyone want to add anything?
Yeah, I'm happy coming on this. First of all, let me say, crypto isn't a homogeneous thing. I always broadly divide it into two parts. There is what I call unbacked crypto of the Bitcoin sort. And I've made a number of speeches on this. I mean, the key thing I would say is it's not money. It doesn't have the characteristics of money. It doesn't have, if you like, a sort of, an assured nominal value. But it is an asset, it's an investment. And really going back to the discussion we were just having previously, I mean, I would warn people it's a very volatile investment in terms of its value. Please go into it knowing what it is if you're going to invest in it. That has one sort of, in a sense, set of regulations around it. It goes back to your point about advice and guidance in some parts. Then there's so-called stable coins. They're rather different because they do sort of purport to be money. We don't really have them in sterling at the moment, any great extent. They do exist in dollars. And there is a big question around, again, if it purports to be money, what's the regulatory framework that should sit around it to give people the assurance that it will have the characteristics of money? We came out with a discussion paper, and we were going to issue a consultation paper actually before the summer, and we envisage having a sort of regulatory framework. And we're responsible for so-called systemic stablecoins, so what might be the big things. Now, I think the interesting thing in the US is how is that regime going to develop there? Are we going to see dollar stable coins take a bigger role in global payment systems, and what sort of framework are they going to put around? Because at the moment they don't really have a framework around them. The previous administration was using really sort of legal enforcement routes in courts to try to create a framework. But it wasn't, in my mind, really working very well because the courts were sometimes they'd win cases, sometimes they'd lose cases, and the result was frankly a bit hit and miss. So I think we are very keen and frankly interested in how that stablecoin world evolves and what are the sensible protections to have in place. And to finish on central bank digital currency, yes, we are continuing to evaluate it, and we will take a decision with the government, and we've said, of course, it will have to come to Parliament as it should if we decide to go ahead with it. And the key issue there, I've said in a number of speeches, I think, is actually it's not should we have central bank digital central bank money. It's actually how do we exploit what are the very real benefits, I think, of digital technology in the payment system. Is it best done in the commercial bank payment system or the central bank world? Now, we'll see. But I think there are real benefits to digital technology which we should want to get and harness.
Thank you, Governor.
Thank you very much. Dr. Chief Sander.
Thank you, Chair. I was interested, Governor, in what you just said about the recovery from the financial crisis. I have two questions, if I may. The first of which is, after the financial crisis, you point out that we had a slow recovery, indeed, across OECD, G7 nations. Do you think fiscal policy there had a role? Either because some would say it was constrained, or others would say because governments didn't react accurately given that the zero lower bound. But do you think fiscal policy had a role into why those recoveries were so slow?
I'm not going to offer a comment on I think I could imagine where that was leading to, if you don't mind me saying so, in terms of the policies of the coalition government at the time. I don't really have a view I can sort of...
If I may quickly, so it's not about the... Because either, you buy the argument that fiscal policy was constrained for a reason, or you say that they constrained it themselves. But in a world where, let's say, fiscal policy was looser, because either it could be or it should have been... Would you see the recovery?
Well, if you remember back to the time, fiscal policy, as you say, was highly constrained because actually the obligations and the in a sense came to pass from the financial crisis were very substantial. Obviously, a huge amount of money had to be put into the financial system to support it. We also had, of course, quite a very deep recession, quite a deep recession that followed it, and there were consequences for fiscal policy of that. So I think the governments at the time were evaluating what the best course of policy was in the light of that. And I say I'm not going to sort of second guess them in that sense.
Do you think that, whatever the outcome, either constraints or otherwise, do you think that had an impact on growth in the following years?
I think probably the issues are more structural than that. I think what we observe is that, I would say is that there was quite a substantial fall off in investment.
You don't think fiscal policy had an impact on that?
I don't think it was probably the major thing. Now, I say the other question you have to bear in mind is, the growth rate of productivity before the financial crisis was actually very impressive. The question is it was it frankly sustainable or not? It turns out to not have been. How much of that was due to things that caused the financial crisis? Again, we could debate at length. But what we saw was what we have seen since the financial crisis for 15 years now is a low rate of investment. And I think, as I say, both the previous government and the current government, I think, shared shared view here. I don't think there's much difference between them in terms of saying we've got to raise that rate of investment.
I say I'm not making a political point. The point I'm making more is, because you said earlier, you talked about the operation of the APF or quantitative tightening does have now fiscal implications. The bank has a secondary objective to support economic growth. Yeah. So the question I'm getting to is that if you think the APF is impacting fiscal policy and fiscal rules, as you stated earlier, it's also having an impact on economic growth as well. So my question is, how are you incorporating that within your action at the moment?
Can I say, I mean, I think if you go back in time, and here I mean, I have to say, you know, not so much now, but we used to read a lot of this stuff about the APF. To do an overall cost-benefit analysis on that policy, which is the only sensible ultimate thing to do, you have to look at the consequences, as you rightly said, for policy over the last 15 years of that policy. Now, one of the things I would point to is, I think, you know, it has had very beneficial effects. So, for instance, you know, and it's only one contributor to this, we have had a much lower rate of unemployment during the last 15 years than historically we had, and that, you know, most organisations, including the Bank of England, spent most of their time forecasting we would have. So there are real benefits in terms of the policy framework that was in place.
Thank you. I'll pass over. Thank you, Chair.
Thank you very much. Dame Harriet Baldwin, back to you.
Thank you very much, Chair. So obviously recently we've had a lot of volatility in Nvidia share prices, and we have therefore sort of through artificial intelligence seen some sort of structural instability, and I wondered both directly through the stock market movements or indirectly through the impact of artificial intelligence generally on the financial markets, whether you have sort of changed your view of the risks that artificial intelligence potentially poses for your committee to supervise. Yes, and I can see Mr. Benjamin.
So I would say two things. I think there's two different things. The movements that we have observed in financial markets are movements in the equity prices of technology firms who are investing in artificial intelligence. I don't think those movements have been caused by artificial intelligence itself. So those are, I think those are two different things. There are views that the market takes on the prospect of those companies, given developments that are happening. So that is one thing. I think separately, in terms of artificial intelligence itself, the committee is soon going to set out its thoughts on the way in which it can impact financial stability from a system-wide perspective. And I think I would distinguish two things in terms of how it has developed over time and where it is at the moment. You've got two phases. The first phase is how financial actors in the system use artificial intelligence to automate what they already do. And the second one is going the next step, which is to then use artificial intelligence to make decisions and make judgments and take trading or management decisions. And I think there's different degree of maturity in terms of where the financial sector is on those two fronts. But what is very important is that we focus our monitoring on the key system-wide impacts of artificial intelligence. For example, the extent to which decisions, management decisions, business decisions, could cause some herding in financial markets of positions and concentrations because of that. The extent of potential reliance on critical but less well-known third parties who are common to different actors using the same tools, or the extent to which an individual player in the ecosystem may adopt an artificial intelligence-based strategy without understanding what the ultimate consequences might be on the market and the economy as a whole.
All this could amplify.
It could, absolutely. It could amplify shocks, it could amplify instability. So that is very much the focus we have at the moment, is to monitor how those channels could affect financial stability and to understand what those channels are. That is the stage we're at. So asking those specific questions.
Can I one point that I know Colette wants to come in, if you mind. I think I just want to comment on this week's events, actually, and the financial stability implications, because it's very interesting. One of the things we highlighted in the financial stability report, and have done for a while, actually, is that, as Nat was saying earlier, we are very, very focused on what I call the sort of, the uncertainties of the world and the geopolitical risks. However, against that, as we highlighted in the report, we've got this compression of pricing of risk. And you see that both in credit spreads and you see it in equity prices. And one of the risks and consequences of that is that when you get a shock to the system with this sort of, in a sense, contradiction of your worries about the world and the pricing of risk, you could get a much more volatile reaction than you would want. And I think we've just seen that happen this week. So it's an example of quite a volatile market reaction to a piece of news. The other thing I'll say is, from the economics of it, I'm not sure how big this news really is in that sense, in terms of, if I was in the AI industry, because there is something called the Jevons paradox in economics, which says essentially that if you get a piece of news that cuts the cost of a technological innovation, you will actually increase demand for it. So, we could if you're in the AI business, this is not bad news necessarily. It may actually increase.
What was that? His law?
It's Jevons paradox. It's named after the 19th century economist.
To be modest again.
William Stanley Jevons. He did it for the coal industry actually originally. So you can take me out of economic history, but you can't completely.
No, you can't.
Collect.
No.
You're in good company in this room, I think.
Yeah. I'm going to bring the level down a bit now, Chair, from the erudite comments of the Governor. I've just been reflecting, Dame Harriet, on thinking about, going back to your question about unintended consequences and the abolition of risk and all that. Thinking about the things we've been talking about in the last few minutes. We've talked about crypto, we've talked about AI. We haven't really touched much on cyber, but that's sort of underlying this. And, when the FPC first got going in 2013, I don't think any of those issues will have been even on its agenda. So what that's telling us, I think, is that here's a very complicated system, really important to our fellow citizens, and its ability to change, but also its openness to all sorts of risks that we might not have envisaged is very considerable. So I think when you're thinking about risk and, the consequences of regulation, you have to think about all the other things that cause risks. And how again, if you're running a financial services business, all the things you'd have to be worrying about. And I don't know quite where, regulation would be on your sort of dashboard. But, when you think about things like cyber and AI and crypto and all of that, might not be very high. That's just my observation.
Thank you, Dame Colette.
Thank you very much indeed. John Grady, MP.
Yes, thank you very much. Maybe a question for Dame Colette. When we were talking about the international situation, what that leads to on those big risks like climate change and cyber potentially is a situation where it becomes much more difficult to work with people that we must work with to manage the very many risks that you identify in this wonderful report, which I was reading in the midst of the tempest in Glasgow on Friday. Are you more or less optimistic that the Bank of England and our other regulatory bodies can work with our international partners, and those we must work with, to address these risks, which are many in this report, that require regular, repeated, patient working and reaching agreement? We've touched on Basel, but we've got climate change, the emerging vulnerabilities at the intersection of PE and life insurance, where you mentioned arbitrage between different jurisdictions. Cyber's another one. Are you more or less optimistic about?
And you're addressing this question to me rather
perhaps,
than...
and then the rest of the panel perhaps, but quickly, because time's marching on. I don't want to get into trouble with the chair.
I feel fairly optimistic about that, in the sense that, as I've just said, if you go back to when this committee got going, we were not thinking, I wasn't, we were not on it then, but,
Was that, Sean?
Were you? Oh, well, we know who to blame then, if I may say so. But, the risks that have emerged, they're not just ones that the Bank of England can see. I think they're widely seen and shared amongst people who have these kind of responsibilities in other jurisdictions. So, for myself, I feel optimistic that we can work together with we can collaborate with partners on addressing these risks. Not easy, climate, one of the most difficult ones, but I feel optimistic about the sort of shared conversation, if I can put it like that.
Thank you.
Thank
you very much,
Meg.
Mr. Grady.
Dame Colette.
Governor, you rightly challenged just earlier, saying that public policy on risk versus growth is our responsibility, Parliament, this committee, government, as well as for you. But I just think it would be helpful. We've been having quite an esoteric discussion at times here, and this is a pretty critical part of the agenda, and we had a good discussion around it. How would you explain to a member of the public, how would they understand the decisions at that margin, the risks to them? How would you put that into plain,
That's a tough
plain
question.
English?
It's a very tough question. I think we have to do more on this front. I mean, I would say I do welcome these hearings, because one of the things that colleagues I think have heard me say this, I do have the concern of is, and I don't say this to denigrate monetary policy at all, that monetary policy in our world gets a huge amount more public attention than this stuff does, and yet this stuff actually has doesn't have a greater bearing, but it has a very big bearing on people. So I think how we get across these points, about embedded in this question about growth, is the question about, for instance, how much risk people should take, how they should take it, what the role of the financial services industry and the role of the regulators is in managing that process, and having what I would call a very open, frankly, exchange on this to set expectations is important, because otherwise, and the Chancellor has said this, and I think it's right, otherwise, we do, I'm afraid, I'll say this from our point of view, when things go wrong, we know what happens, and that's why, of course, you get, some of the things go on in terms of the way regulation develops, because if you come on and say, this is always going to end badly, then of course the regulators will respond in that sense. And so I think if we need to set that, set that balance. Then we have, as you rightly say, we've got to communicate it, and that's really hard. Really hard.
Do you think you could do better at communicating it? And I mean, that's you've thrown us the gauntlet.
We should keep doing more and think about how we can do better.
Just think, if you're an average person in Hackney South and Shoreditch, in Salisbury, in Earley and Woodley, in Loughborough, wherever, then what would be the takeaway message about the balance between risk and growth? It might be, if you've got someone tuned into personal finances, they might be thinking cash ISA versus stocks and shares ISA. But for a lot of people, that would be where it would end, begin and end. But a lot of people wouldn't even get that far. Yeah. So is there something that you're thinking about?
It is. I mean, you get into the question of financial education, which we have a bit of a role in, but I have to be honest, we don't regard ourselves as being, in the lead and the only responsibility, but we will certainly have a role and assist on that. So I'm very open to the idea that we should try to collectively think what more can we do, because I think in resetting this or perhaps even setting it, I'm not about resetting it, these sort of principles and boundaries, I think it's that you're absolutely right. It's very important that we include this issue in it.
Okay, and just going back onto a point made earlier about mortgages, when Mr. Glenn was talking to you, asking questions, would there be a point where the FPC might intervene over the FCA if you felt the mortgage market was getting too risky?
We can, yes, we can. Yes, we can. We can give recommendations to the FCA.
From what you've said, that's not likely. I mean, you actually have quite a positive story on the mortgage market, Mr. Benjamin.
It's materialised.
Well, can I thank you very much indeed for your time. I mean, in summary, we've heard a lot of useful things, but just to pick on some of the interesting headlines that have come out of today, we heard obviously about the new tool you've got to provide lending to non-banks in the face of gilt market disruption. So that's heartening to hear that that's there, and you seem to be very pleased about that. We've also heard that growth, of course, may come with simplification at the nexus of different regulatory regimes, and we've been having quite a lot of discussion as a committee about the risk regulatory function and growth, so that's quite interesting. And the Governor, you noted that despite significant shocks to the economy and the financial system, there hasn't been a significant increase in mortgage arrears, which may be a sign that the system is working, and that also that loosening lending standards, point highlighted by Mr. Benjamin, on mortgages without building new homes may just lead to higher house prices. So those are things I think that if we're talking about communicating to people in the real world, these are things that really matter. So can I thank you very much indeed for your time.
Thank you. Thank you.
Order. And could I just ask our witnesses